intro about this group and why we're here today. So CWEEL is a division of AE, Association of Energy Engineers, formed in 2007, specifically meant to be, a group of professional women and allies supporting underrepresented demographics in this historically more male-dominated field, with a mission of supporting career development through mentorship, networking, scholarships, and providing technical and leadership training opportunities to folks. This is the National Governing Council. So this group helps steer the direction of CWEEL within the larger AEE. These committees are also seeking members, so you can always check out cweel.org if you're interested. And then here is the local CWEEL group, CWEEL New England. So that's an advisory committee, currently led by Brittany and Juliana as leads. Mariette and Aparna are chapter liaisons. And then additional members help make events happen for the group throughout the year. And we're always looking to grow the group. So you can also reach out as well if you're interested in the local chapter. So a little bit more on that, how to get involved. First and foremost, becoming a member of AEE, which some of you likely already are. And then after that, good news is it's free to add CWEEL as your to your existing AEE membership. Show more about that in a sec. And if you're located in New England, you can reach out to get on the mailing list and get involved in that local advisory group that we just showed. So here in New England, we have a group already, but we can also provide support to help other groups get stood up around the country where there isn't one already. So regardless of where you're located, you can always join CWEEL Governing Council Committee and have a broader impact as well. So a little more nitty gritty. If you are, again, an AEE member, on the website, aeecenter.org, when you've logged in, you do have the option to add the CWEEL as part of your add-on membership, either when renewing or at any time. This kind of shows you the steps to doing that. And then, as mentioned, big focus is holding events throughout the year. So making a plug for a future networking event. This would be the second annual August Happy Hour series. So last year we had events on the same evening in Boston and Providence and Hartford. And so this year, maybe depending on interest, could be more to come as well. So multiple locations around New England at the same time, and we are still choosing the best places to meet. So if you join, you can certainly have input in helping us figure that out. And so if you have any of these ideas or interests or questions, want to know more how you can get involved, again, here is the chapter email and the chapter website. All right, and then more specifically on why we're here today. So our presenter, Danielle, she's been a financial advisor for the past several years, specializing in retirement and divorce planning. She does have a background in engineering from Northeastern University. So she brings that data-driven problem-solving approach to financial decision-making and planning in her current role. So she spent over a decade previous to this in the energy efficiency field, got to work with a few of us here, New England based, and also has an adorable dog, Tuffy. And then a couple housekeeping things before I hand it over to Danielle for her presentation. Do hold, verbal questions until the end, and we'll kind of a focus on responding to typed questions. Feel free to pop those in the chat, and you can do that at any time through the presentation, and we'll just start getting to them after the presentation. If for whatever reason you're not in a position to type in answers, you're on the move or whatnot, once the presentation is over, you can use the raise hand feature, and we will try and get to those verbal questions as well. And I will now hand it over to you, Danielle.
Okay. All right, so I should be good to share now.
Yes, I have stopped. Now you can begin.
Okay. Can you see my slides?
Yes.
I just want to minimize everyone here. Okay, awesome. Well, good afternoon, everyone. Thank you for joining me today. So I'm Danielle, and I'm excited to be here today to talk with you about something that I think is incredibly important, which is building a strong financial plan. Before we dive into the details, so I do want to give you a little background of my personal journey. So as Jamie said, for many years, I used to work in the field of energy engineering. I had the pleasure of working with Jamie for probably like 3 or 5 years. I don't remember exactly, but I was really passionate about energy efficiency. I kind of felt like I was saving the world, like one building at a time. And obviously I dedicated a significant portion of my career to that. But during those years, I was always feeling like I had like 3 major financial frustrations. I felt like I was a really good saver, but honestly had no idea if I was making the right long-term financial decisions, and I was constantly questioning if I was setting myself up for a secure future. I also felt alone. I felt like I had no one to ask questions to. I didn't know who to trust, and I found financial planning or financial tools very complex. And I just felt it was really daunting, and I didn't have anyone to support me through that. And I also started to realize over time that as a female, I just had more financial obstacles to overcome than like some of our male counterparts. We have longevity on our side, which is great, but that means we have to, when we couple that with the gender wage gap and the wealth gap, it means we just have more unique financial challenges that require careful planning and strategy that we have to think about and plan for. So I actually ended up having a very pivotal moment in my energy efficiency career when the business unit that actually Jamie and I were a part of had to shut down. Some of you may have heard of it, NG Services, excuse me. That was an incredibly challenging time. But during that time, I realized that my passion for energy efficiency had truly waned. I loved the people that I work with, but was not passionate about the work anymore. And so during that very difficult time, I just started to reflect on what did I really like doing? What was the topics that I liked spending time on and talking about? And then at the same time, I was also realizing a lot of my lady friends were experiencing some of the same financial challenges that I was experiencing. So it really became clear to me that like my true passion was in helping women become more financially literate and confident. So I decided to make a career pivot, and I moved from energy efficiency to financial planning. I really wanted to support people, especially women who were feeling the same frustrations that I have or had. So now through the work that we do, I have much greater clarity on my long-term trajectory. So I feel much more confident that I can retire and live a lifestyle that's even greater than the lifestyle I'm living today. Two, I have the resources that I need to help me achieve my financial goals, and I plan for a lot of the risks. And I feel confident now that I can overcome any financial obstacles along the way because I plan for it. So today I'm excited to share with you the 4 steps to building a strong financial plan. So over the next about 30 minutes, we'll explore some of these steps in detail. And then I hope that a lot of you will leave this session feeling empowered and ready to take control of your financial future. So let's get started. So I actually want to start by asking, what do you guys want for your future? Um, so um, think about like all the hopes and dreams that you have for you, your job, your families, where you want to live, how you'll spend your time. What are your financial goals? What are your goals for you and your family? I love to see some people throw it in the chat. Oftentimes, I find that a lot of us share a lot of similar goals, yet we don't talk about how we plan for them. So throw them in the chat if you're willing to share. But what I find that no matter what our goals are, the best way to reach them is typically through planning. And since most of these goals need to be funded in some way, what we're really talking about is financial planning. But first we need to know where you stand. So I actually wanted to, I'm going to pull up a quiz. I thought it would be great. Pull this up here. I'm just going to zoom down a little bit. So this is a short little quiz. It's a financial fitness worksheet just to figure out where you stand on your financial readiness. This helps you get a better sense of where you stand today. So look through these 8 questions and just answer true or false. I'll give you a minute to write it down on your end. And let's see, I can see the timer here. So you can just sort of write this down in your own notebook. Nobody needs to see it. Nobody needs to share it. And let me know if anybody can't read it. I tried to zoom in so that everyone could see it. Okay. Does anybody need another minute or so? Okay, so what I'd love for you to do is add up your score. So for every true you chose, give yourself 1 point. And then for every false you chose, give yourself 0 points. So add that up, and then you want to look on the right side to see how you did. If you scored 7 to 8 points, you have a high degree of financial security, what we would consider financially fit. You've got a lot of clarity around what you're doing and if you're on track. If you've got 4 to 6 points, you're on the right path, but you could probably make some additional moves when it comes to your financial planning. And if you're in the 0 to 3 bucket, don't worry about it because you're taking the right steps by being here today to learn what you need to do to set yourself up in the right direction. I can send this out. I can have Jamie and Mariette send this out to everyone afterwards if you'd like to look at this in more detail later. So, understanding a few basic steps can help us improve your finances right now and down the road. So, these include 4 main steps. So, understanding your cash flow, protecting your income, protecting your income, your family, and your assets, developing a savings and investment plan for all of your goals, and then creating a strategy to manage your debt. So today what I want to do is cover these strategies high level so you can build a strong financial foundation. So we'll start with understanding your cash flow. So understanding your cash flow. So we're really just talking about managing your money to cover what you need, what you want, and then what you owe. So cash flow refers to how much money you have coming in and going out every month. Obviously, the goal is to have positive cash flow, meaning you spend less than what you take in every month. I'm sort of curious, and maybe do the thumbs up if you have access to it. How many people actually track their expenses so they know how much is coming in and how much is going out every month? Well, yes, Mariette, you better be. Awesome. So I see a couple of thumbs up here. Okay. Go. So when we think about your spending, we want to have clarity on what's coming in and what's going out every single month, and that's pretty easy to do. So usually you just want to start by taking an inventory of all the ways you're spending money. You can download an app to do it. There's a lot of good apps that are out there. A lot of your bank accounts and your credit cards will actually auto categorize a lot of what you're spending on. So that's a great avenue for you to see what your spend looks like. And then if you're nerdy like me, you might also just have your own spreadsheet so that you can actually track it. And if you don't have a spreadsheet, you don't have an app, don't worry. A great default is to just save your receipts every time you get them, save them for at least 3 months, and then start to tally up how much you're spending towards everything. And then don't forget about the expenses that happen a few times a year. So it might be the car insurance you pay annually, the water bill you pay every quarter. You also want to get a tally of what those are because they are part of your cash flow. It's just not happening on a monthly basis. So ideally, what you want to do is understand what those, I call them the more ad hoc expenses, tally those up, divide that by 12 so you can add that in as a line item for your monthly budget. And then you want to compare your spending to the 20-60-20 rule. So if you look at your app or your budgeting worksheet, you can see how your expenses then fit into this rule. So ideally, we want to be saving 20% of our gross income every month for short and long-term savings. And ideally, you want to make saving a habit. So you want to think about saving this amount first and then spending the rest on what your essentials and your fun stuff, right? And then essential expenses probably should be no more than 60% of your take home pay. So this includes housing, transportation, food, clothing, anything for your kids, your health insurance, your healthcare, right? And it should also include paying down debt such as car loans, mortgages, student loans, credit card balances. And then ideally, it should leave you with about 20% that can go towards discretionary. So think about all the fun stuff that you want to do, that concert you want to go to, the vacation that you want to travel to, that massage, that fancy massage you like to get at a spa day a couple of times a year, right? And don't worry if your spending doesn't quite line up with this 60-20-20 rule. If at a minimum you can make 20% of savings a habit, then you're in a good spot. If it's any less than 20%, you might need to start thinking about and making some hard decisions about what are your goals that you want to save for and what are you willing to stop spending on. Okay. Step 2, we want to think about what we are protecting. So there's a few big things that you want to consider protecting in your financial life. So your paycheck and your loved ones. So think about your goals, the short-term goals, the long-term goals. What would happen if you became sick or injured and you could no longer work? Would you have a good shot at reaching these goals? And I know this isn't something anybody really likes to think about, but it's a possibility. So let's think about it. If you think about the type of assets you own, throw it in the chat if you want to, but how many people here own a home or a car? Hopefully, um, hopefully Jamie owns a car. So think about whether we insure, great, we own homes, we own houses. Think about, do we insure that asset? Do we insure our car? Do we insure our home? Why do we insure those things? And that's to replace them if they get into an accident. If you total your car, do you have $40,000 sitting in a bank account to buy a new car? If a tornado comes through and rips down your home, do you have $400,000 to replace that house? That's why we have car insurance. So I want everybody to take a minute and I want to start to show you the value of protecting your income. So I want you to grab your calculator either on your computer or on your phone. And I want you to do this calculation. So if Jamie, you could be my guinea pig, or Mariette, if you don't mind. Take 665 and subtract your current age. And then take that and multiply that times your current salary that you earn today. So Jamie or Mariette, would you mind being my guinea pig and tell me what that number is?
Could you say that one more time, just to make sure I did it right?
Yeah, take 60
Same.
minus your age.
Yep.
Now multiply that by your current annual salary.
Okay.
Is that number, you don't have to tell us the number, but is it more or less than your car?
The value of my car?
Yep.
More.
Is it more or less than the value of your home?
Probably more or about the same. Yeah.
Okay. So the question is, thank you for being the guinea pig.
Yep.
Are you insuring your income so that if something happens to you, you can replace your lost income? Because if something happened to you today, all that money, that's your earning capacity. And I didn't even account for inflation. That's your earning capacity between now and retirement. So if you can't work, would you still be able to reach your goals? Can you replace that income and still reach your goals? So first, oh, there it is. Mariette got the right slide. First, you want to protect your income with disability income insurance. So most people are surprised to hear that about 1 in 4 people will actually become disabled at some point in their career. Oh, maybe that was the slide over here. Hang on, sorry, it's going in the wrong direction. Here it is.
Did you want me to launch the poll or not? Sorry, I jumped.
Yeah, hold off for 1 second.
Okay.
Sorry about
folks.
that.
Yep. You'll vote again in a minute.
You'll vote again in a minute. Okay. So most people are surprised that about 1 in 4 people will become disabled at some point in their life. So most people, I think, they think the word disabled and think, well, I am able to do my job. I have all my limbs, like I'm not disabled. I think there's sort of a misconception with the word disability. So just to give you a little context, some of the main causes of disability are actually meaning things that can cause you to be out of work for an extended period of time. Musculoskeletal and back problems are the #1 reason why people are out of work, followed by cancer. And then we see a lot of other folks that are out of work due to pregnancy complications, injuries like from a car accident or from, sports leagues. And then we also see other people having strokes that cause them, like at an early age, that cause them to be out of work. And so a disability does not mean you're necessarily disabled for the rest of your life, but that you have an event that happens in your life due to an illness or injury that, again, causes you to be out of work for an extended period of time. So now, how many of you know if you have group disability income insurance from your employer? Let's see. Yes, do the question again. Sorry, thank you. Okay, some people know, some people don't. Some people don't have it. Okay. For those that have it, do you know what percentage of your salary that insurance would cover if you became disabled? So not many people have or know the percentage of their salary that insurance would cover if they became disabled. Most insurers most employers, I should say, here we go, typically only cover about 60% of your salary. That's before taxes are taken out. And this does not include any bonuses or commissions. So it leaves you with at least 40% less of your money coming in every month. So the question to ask yourself, and you can turn off the poll. Thank you, Mariette. The question to ask yourself is, would less than 60% of your income be enough for you to live on? For most people, the answer is probably not. But by getting your own supplemental disability income insurance, you can cover more of your income that your employer does not cover. And frankly, it's one of the most affordable insurances that you can find to protect one of your most important assets. So the other piece of protection that we want to talk about with folks is protection for your loved ones if something should happen to you. So like disability income insurance, you might have some life insurance coverage through work, but is it enough to protect the people and their financial well-being who depend on you? So think about, are you married? Do you have kids? If you weren't there today and your income was no longer there, would they be okay financially? So you want to think about what you would want to have covered in the event something happened and you weren't there to support them. Would you want to cover funeral expenses? Is there debt that you would be leaving behind, like a mortgage or a car loan or credit card or private student loan debt? Would you want to cover your kids' education because you were going to save for their education anyways? So if you determine that you need more life insurance beyond what might be offered through your work, you want to make sure you talk to a financial professional because there are different types of life insurance. So you want to understand the different types, pros and cons, so you can determine what makes the most sense for your specific situation. Okay. Next, we're going to talk about saving, which is obviously the most fun part of building a financial plan and creating financial security, because it helps you build up the funds to cover up your goals and all the surprises that life throws at us, right? So it really is helping you afford the life you want tomorrow. So those are obviously all very important things, but we can't save all of our money, right? So how much should you save? Okay. The general rule of thumb is to allocate about 20% of your gross income, we talked about that before, to saving and investing both short and long term. Again, you want to create that habit of saving first and then spending what's left. But of course, the amount you should actually save depends on what you want for the future. So when you think about like your goals that you maybe wrote down in your notebook when I asked at the beginning, you want to write them down, be specific. Is it retirement? Is it paying for your kids' education? Do you want to start your own business? And you want to really be as specific as possible. So for example, we have plenty of folks that want to retire early. They don't want to wait until their mid-60s, but they would love to retire at 50. Well, we might need to save a little bit more than 20% of our income. Or the people, maybe they want to buy the penthouse in the city because that's their dream of where they want to live and spend their time, right? We might need to save a little bit more if they don't want to live in the suburbs. So trying to define your goals as specifically as possible really helps us figure out how much can you save every month towards these and how much are you willing to save in order to get to that goal, and how quickly we need to get to that goal. So does anyone here have an emergency fund? And do you know how much money you need to have in your emergency fund? This will be our next Zoom poll. Is the poll working? Awesome. Maria, is the poll working?
It will be. Hold on. Sorry, I was slow.
Okay. We're newbies at polls, so thank you all for entertaining us.
Now is it up?
Yes.
All right.
Awesome. Awesome. So I see some folks say 1 to 3 months, 3 to 6 months, 15 months, 1 year. Yes. Okay, awesome. These are all great responses. All right, let me get that out of the way. We can end that poll. I'm gonna close that. Okay. So here's why emergency funds are very critical. So no matter how carefully we plan our finances, there will always be the unexpected. The car repairs, the vet bills. Yes, Tuffy has had to go to the vet in the middle of the night, and the trip to the ER with the kids, right? What data actually shows us is about 32% of Americans couldn't cover an unexpected $400 expense without using a credit card that they then couldn't pay off. So they're borrowing the money, which ends up costing them even more in interest. The goal is really to have 3 to 6 months of living expenses in an account you can easily access. So that should be like a checking or a savings or a money market account. And it's okay if you don't have that yet. You can start small and add to it over time. I think ideally you want to build up to the 6 months, and what your true emergency fund ends up being should also be a carefully thought out process, because if you own a home, you may have more expenses than someone who rents. Someone who rents does not have to replace the refrigerator when it dies, but the homeowner does. So we want to be really thoughtful about how much you actually need to keep in an emergency fund, but recognize keeping money in your emergency fund. We don't want to keep too much in there because the money that's in there is actually not working very hard for you. Okay. So to achieve your longer term goals, we need to invest our money. We've got to invest it in a way that will allow your money to grow. So investing is particularly important when we're saving for the long term. So specifically like saving for the down payment on a home in 10 years, your kids' education, your own retirement. And starting small is okay, but the sooner you start, the better. And that's because of compound interest. So And compounding interest is when you earn interest on interest over time, and it can really make a big difference. I really like this chart because it shows when you start saving at different ages. So if you're 45 today and you started investing $100 a month, so over here, $100 a month, and let's just say you get like a 6% return in the market, including the compound interest, you'd be able to double your money by the time you were 65. Okay. But if you started saving 10 years earlier at 35, you'd actually be able to triple your money because of that interest on interest effect. But if you started saving at 25, you'd actually quadruple your money. So the bottom line is you want to start saving as early as possible. And we are all living longer these days, and especially women, we tend to live longer than men, which is great. Who doesn't want to live a long life? But it just means we have to cover longer years in retirement, potentially upwards of 30 years. It's a long time to live off of your savings. So the earlier you start building up, the better. You can start taking advantage of compounding interest. And let me turn off my little drawer here. Okay. Right. So anytime you invest, there is risk involved. There is no such thing as a safe investment. Nothing's a sure bet. Okay. And everyone's tolerance for risk is different, which is absolutely okay. It's important to actually use what we call like a personal investor profile or a risk tolerance questionnaire to actually figure out what is your comfort level with risk? And it should look at these important factors. How much time frame do you have until you'll need the money? When you're going to start using the money in that account, how long will you be making withdrawals for? So we call it your withdrawal time frame. How much of your money is in whole life insurance, pensions, personal savings accounts, and fixed interest assets? We consider those more stable assets. They don't have volatility, but they, of course, don't grow as fast as an investment does. And then there are other questions too to help figure out, like, how much personal liquidity do you currently have? What's the stability of your income? Think about, are you in an industry that is pretty stable and you expect to keep your job? Or are you in an industry where you get laid off every couple of years because that's the world, that's the life of a startup company, right? So you want to think about these and really come up with like a personal tolerance for your risk and what that means for your investing. And when you can understand this, you can be more confident when evaluating your options. And if anyone wants to like figure out what their risk tolerance is, we can set up some time where you can do like a personal investor profile. So today, when it comes to investments, investors have a lot of options to choose from. So you've got different account types, you've got different investment selections, and where you invest your money depends on what you're trying to achieve, your risk tolerance, again, how long you're investing, and what investment options are available to you. Your work and employer may only give you certain options in your current 401k plan compared to your IRA. Ideally, you want to be properly diversified. So diversification means splitting your investments up into different account types that have different tax, liquidity, and growth characteristics, and splitting it up into different assets so that you're not putting all of your eggs in one particular basket. So you want to find the right combination of account types and investment selections in order to meet your goals that suits your specific needs and your specific timeline. And the assets that we select within your account type, that determines what we call your asset allocation. So asset allocation is exactly like it sounds. It's how you allocate your assets or split them up between different types of asset classes in order to create a diversified portfolio. So it doesn't have to be really complicated, but it should include at least 2 asset categories to be effective, like equities and fixed income. And it should be, in order to be effective, it should have a unique combination that aligns with your long-term investment plan, because all these asset classes, they just act differently and they have different seasonality. So for example, equities, we call those stocks typically, they offer greater long-term potential growth, but they come with risk, a higher level of risk. Fixed income securities, such as like bonds, cash alternatives, they have their own pros and cons. So they're a good choice for some stability, but it's also possible to lose money by investing in them. So they are not totally safe. So as your investment portfolio grows over time too, you want to end up broadening your asset allocation. So if you see here stocks, we can actually break that up into the US stock market with different size companies and the international market. And the same thing goes for bonds and cash alternatives. So even though there are clear advantages, and let me see if I can zoom in here. That probably is a little bit easier to read. There are a lot of clear advantages to diversification. But what I find, and asset allocation, but I find that many people's portfolios are just like a hodgepodge of investments that they've selected based on something somebody told me was like the hot tip last year or last year's top performer or top performing asset, rather than it being defined based on what your goals and your timeline is and your risk tolerance. So a great example is I have a lot of people tell me their investment is safe. It's in the S&P 500. And that's quite the fallacy, because if you looked at the S&P 500 this year to date, it's actually not doing very well. And in fact, the entire US market is not doing very well in 2025. However, everything outside of the US market is doing very well. So if there was one asset class that it could actually lead the market every year, that might make sense. But the markets are always changing. There's a lot of factors influencing the international market, the US market, bonds versus equities. And it's really impossible to predict who's going to be the next best asset class that year. So this is a chart that I love. I like to call it the quilt, but it actually shows with all the different colors, each different asset class. So you might think that some look really good. So here's one that people think look really good. International emerging market. Look, it was at the top 3 times over the last 15 years. But then it was at the bottom in 2011 to 2018, 2021. It was the second worst in 2022, so on and so forth, right? When you see all this movement, it's really difficult to figure out who's going to be the winner next year. So when asset classes move in and out of favor like this so quickly, if people are trying to shift their money around to try to catch the next asset class that's going to be the next winner, what ends up happening is they end up missing out on a lot because they're trying to time the market, and they've got to time the market twice because they got to know when's the right time to get in and when's the right time to get out. Ideally, the better approach is to have that diversified portfolio that we've been talking about. So you can see that on here in white. So you can see it's a pretty solid performer just straight through. And that's because it's not relying on one asset class in any given year. It's not going to have the best return every year, but it's also not going to have the worst return every year because you'll always have something bad balancing out something that's doing well. And it also means you've got a lot less risk if you've got some good balancing out the bad, right? Okay, so let me clear these. Get to the next slide here. Oh, hang on, I have to zoom out. There we go. Okay. So we just talked about how timing the market isn't a great strategy, but it's not surprising that most investors actually still make emotional choices. So they'll jump in and out of investments based on what's going on because they want to try to get the best return. No one wants to lose money, even in the short term. I know it hurts, but look at this chart. So this chart shows how missing just the 10 shows how missing the best trading days in the market over a 20-year time period can affect your returns. So if over a 20-year time period, so this is from 2004 to 2023, if you stayed invested the whole time, you'd have almost 640,000 after that 20-year time frame. But if you missed 10 days, you have under 300,000, so you have less than half. If you missed 50 days, oh my gosh, I think that's a $56,000. You don't really have much. And since what we find is large up and down days in the market, they tend to be clustered together. So when you try to avoid these market dips, you end up missing out on all of the great days. And that's going to have a really big impact on your portfolio in the long term. So when you get nervous, when you hear the markets are a little unsteady, so like, for example, this year to date, I've gotten a lot of emails. People are very nervous. Should I take my money out? Should I put it in cash? I need you to have discipline. I need you to stay focused on the long term because the market will go back up. It just takes time. And we don't want to do this in and out because we're going to risk losing out on a lot of wealth in the long run. Okay, let me get rid of my circles over here. Okay. So here we go. So the next thing I want to talk about is freeing up money that you can put towards your savings. And one way to do that is just to be smarter about the debt that you have. And we want to manage it responsibly. If we can pay it off, then we can free up money to allow us to get ahead financially. So you'll often hear people say, no, not all debt is created equal. So credit card debt is obviously the worst debt. It's an example of bad debt because the interest rates are typically very high, they're variable. So that's one of the first things that we want to tackle as part of your financial plan. And the goal should be to pay off the credit card debt ideally within 5 years. Make sure you're at a minimum paying toward the minimum balance on all credit cards. Pay more if possible. And then you want to start with the highest interest rate credit card because that will allow you to pay down your credit cards faster and save you more interest in the long run. That will then free up money that we can either use to put towards more debts or put towards savings. Student loan debt is an example of good debt because it's considered an investment in yourself, and the expectation is that investment will pay itself back through your lifetime with career opportunities and higher income. But still, we know many people feel burdened by the amount of student loan debt they have. So you can always look at loan consolidation or public student loan forgiveness, service loan forgiveness if you fit into those categories. And you have to carefully manage these things because you want to see what the interest rates are now compared to what you have today. And will it allow you to actually save money? Or will it allow you to start paying off the loan faster? So it's a careful decision that you have to make over time based on what's going on in the economy. Managing mortgage debt. So a mortgage is actually generally considered good debt for a couple of reasons. One, you're building equity in something that hopefully will grow in value over time. And then you also may be getting tax deductions for the mortgage interest plus the property taxes you're paying. However, some people are still willing to give up all those deductions if they could actually just get rid of their mortgage. So if you're thinking about this, first, what you want to do is make sure all credit card debt is paid off first and any other debts are under control. And then you've got a couple of options. You can always look at refinancing your mortgage. Can you get into a lower interest rate? Though I'm willing to bet for those on the phone, you probably have rock bottom interest rates like I do. So you are not remortgaging that thing. But could you also refinance to shorten the term of your loan? Can you go from a 30-year to a 20-year loan? And if refinancing doesn't make sense, you can actually look at paying a little bit of extra interest on your principal. So you could ideally keep the mortgage as is and have the flexibility to pay more, pay extra when you can, and that will actually help you pay down the principal faster. So you actually reduce significantly the amount of interest that you end up paying over the life of the loan. So this is an example. So if you had a $300,000 mortgage, and I'm just assuming you had a 30-year mortgage with 4% interest rate and you paid an extra $240 every month, you'd actually save $57,000 in interest in the loan and reduce the mortgage loan by 7 years. That's really cool. But remember, when you're refinancing or you're paying extra towards something, that means you do not have easy access to those funds. So when you're thinking about these decisions, think about, okay, if I want to put extra money towards my debt, what's the interest rate on that debt? And can I get more for my money elsewhere? I'll tell you, my mortgage is like 2.3% interest. I will not pay a dime more on that mortgage because I know I can get more for my dollar in the stock market. I know I could get more for my dollar by paying off my credit card debt faster because that interest rate is 20%. Right, so those are the questions that you want to ask yourself and start to think through. Okay, so just to recap, now we've begun building a strong financial plan or building a strong financial foundation. You want to consider having a financial plan. You want it suited specifically to you, your goals, your specific situation, and just make sure we're tackling paying off the debt, developing your savings plan, make sure we're protecting your family and your income so that if something happens, you guys are going to be okay and can still reach your goals. And then obviously making sure cash flow, we have positive cash flow in order to reach those goals. So I know this is a lot of information and getting a handle on your finances can seem overwhelming. So many people find it very helpful to actually sit down and work with a financial planner who can help you prioritize and think through what should we be saving for all of these goals and where should we be saving. And then once you have a plan, when you find yourself with extra money, now you feel confident about where you're going to put it. I'm going to put it in this account. I'm going to put it in that account for those goals. So you'll be much more driven to continue to save and earn more. So I will stop here. So if anyone has any questions, I think Jamie, now this is like, you can open the floor for questions.
Yes, thank you. Yeah, I will, there's maybe one or two questions in the chat so far, so I'll read those out, and then if anyone, has, this has generated any questions for you, just, toss them in there, or if I see, any hands raised, I can give you the
Yeah.
floor that
And
way.
if you have, if anybody has any questions that they don't want to ask in the group too, you can send it to Grace Baggett. She's on my team. Being here for my emotional support, making sure I'm clicking through the slides correctly. So you can just send her a message on the side, and we can connect with you on your specific question outside of this. But what were the questions in the chat?
Yeah, so one back from the beginning, from Juliana, do you have any tracking apps that you recommend for expenses?
So I've heard, I try to crowdsource information from people too. I use a spreadsheet because I'm a silly person. I'm a weirdo. But I know a lot of people enjoy You Need a Budget, YNAB. And then the new version of Mint, I forgot the name of it, because Mint no longer exists anymore. And then our clients actually have a free portal. When they're clients, they actually have a free portal through Northwestern Mutual. And there's a way that they can track all of their expenses, and it will auto-categorize it for everyone. But I'm also finding a lot of the credit card companies and like the bank accounts, like I've noticed I use Bank of America for my checking and my savings. It also has that same feature, but ideally for tracking expenses, you might be paying on a credit card and a debit card. So you want a place that will aggregate those things. So our Northwestern portal does it. And I know you can do that with the new Mint version, and You Need a Budget. Intuit. Oh yeah, to Credit Karma. I've heard some people didn't like it. That's right. I don't use all of them, so I can't give you all the advice, but that's some of the crowdsourcing information I've gotten from other clients.
I'll jump in with a question that I had, and which was both what were any of your strategies or maybe lessons learned from your your time unemployed after being with a company that's gone out of business, which has also happened for me a couple of times in the past, and then any kind of motivations that came out of that for you.
That's a really interesting question. So during that time, I actually, well, I guess you're asking it more from like a financial learning perspective. Um, I think I felt okay because I actually had a really good emergency fund, and it was on the order of like 9 months, and it was like 9 to 12 months. And I had also built up some money in an investment account that I had accessible to me. So I realized that I actually had a larger emergency fund, and I also realized too that that's why that money is there. Because sometimes I have a hard time spending the money that's in the savings. And I constantly need to be reminded, like, this is an emergency. This is what this fund is for. You're going to rebuild it back up. So your emotions can really get in the way of like your financial plan, even not just investing, it's even just like your checking and your savings account. So I just recognized that I was sort of like emotionally tied to my money. And I needed to sort of put my emotions aside and say, no, I plan for these things. This is why money is here. And I'm glad I had pivoted some of my money to an investment account. So I had it working a little bit harder for me. So I had more money in there than I would have had I just had it sitting in a savings account. And then what was the other part of your question?
Oh yeah, and just what kind of how did it motivate you? Which I know for a fact one of them was like that you decided to pivot and pursue, finance management in your career.
Yeah, I think I just saw it. There wasn't a lot of like I wasn't necessarily seeing it as a financial motivation. I was just seeing it as I knew something was wrong with where I was working. Um, I loved the people, like I loved the people, but like literally I could not care less about the work. Like that's kind of how I truly felt, even though I knew it was important. So I just saw I had to see that as this is an opportunity. It really stinks to have to shut this business down, but use this as an opportunity to like try other things to see what topics you enjoy and get excited about. And financial planning happened to be one of them. It's a great question. Thank you. Any other questions?
And scanning the chat, or if there's any
Anyone wants to
hands.
also jump off mute, you're happy to verbally take questions as well.
Let's see. I suppose did you you talked a good amount about this, but did you have any further, and again, maybe from personal experience, any sort of debt management strategies, or like things like maybe like things to avoid?
Yes. Oh, and that actually reminds me, it goes back to your first question too. Um, I kind of think of it as like, what are the things I would have done differently now that I know, now that I'm more educated on it? And one of the things that I was really like gung ho about after college was paying off my student loans. And I pay them off in 6 years. So proud of doing that. But my interest rates were pretty good. They were like in the 4 to 6% range. And looking back, I know that I would have had more wealth built up in my retirement accounts and my non-retirement accounts had I just paid maybe the minimum and a little bit extra and put the extra money I had into investments. I would have had a lot more wealth had I done that rather than trying to just prioritize the debt. I think managing debt and saving is difficult at times, and it depends on the type of debt. Credit card debt you have to get rid of like as quickly as possible, but you have to save at the same time because if you don't put money in your savings and another emergency happens, what are you going back to? The credit cards. And I was fortunate to keep that under control. So I probably shouldn't have gone so gung ho about my student loans. I wish I hadn't. But now I know, and it just means if I want to get to the same end result, I've just got to save a little bit more in my investment accounts. For student loan debt, what's an interest rate that I would consider consolidating? If you're in like the 8, 9, 10, 11% range, I would look at consolidating. You do have options to get a lower interest rate. Um, that's what I would look at. I have some clients that I found that have like variable student loan interest rates because they're for grad loans, and I don't think you get as favorable rates for graduate loans. So those people are at 11, 14% variable interest rates, and so it's a very obvious thing to like refinance and get that under control. Ideally, you want your interest rates controlled where they can't change often on you. Okay. Any other questions about debt and investing, lessons learned?
If there's none else, I guess I would just ask, like, given the state of the economy where, unfortunately we're seeing a lot of workforce reductions in the federal government and, really stable jobs or historically stable jobs,
Yeah.
losing some of that stability and obviously the stock market fluctuation and whatnot, like what sort of different approach are you having for someone who's starting trying to invest or save right now? And like, how do you balance like you just said about savings versus, you know, paying down a loan or
Right.
something like that. So I feel like the economy has a huge weight on that as well. Can you
Yeah.
kind of speak to that?
Yeah, absolutely. And everybody's a little bit different. And I always think of like financial planning, like we go through priorities. So we might not start everything at once. So we need to evaluate where are you at from a cash emergency fund perspective? Where are the debts and what type of debts? And what do we have going on for investments? For example, a woman I spoke with earlier today, she works in the startup industry. She's been laid off like 2 or 3 times already in her short tenure. So we're actually talking about having a little bit of a larger nest egg because she loves the tech startup world. So we know this is going to happen. So we're figuring out what's the right emergency fund for her. And it may mean we build up the emergency fund first and we do a small amount into her retirement account because we do want to get that going. But once we hit that emergency fund, then we'll start to increase the investments into her 401k, for example. So everyone's a little bit different. But I would say know your industry, prioritize having the emergency fund and paying off credit card debt. Any other debts, I would probably just consider if they're under controlled and good interest rates, I would probably just consider maintaining like the minimum payment so that we have enough accessible cash that you can touch in if there is a potential layoff. Great question. Very relevant. Awesome. So I think we're at the top of the hour, Jamie.
Yes, exactly. Somewhat perfect timing. So yeah, we'll wrap things up and again, yeah, Danielle and Grace, your contact info is there. So I'm sure if anyone has any like kind of follow-up questions that you prefer more one-on-one or just want to learn more, don't hesitate to reach out to them directly. And again, to Mariette or myself, or with the information about the local CWEEL chapter that we shared earlier, to get involved. And thank you all for joining.
Thank you all. It's nice to meet you all. Have a great day.
Bye all.
Bye.